Hello, this is Ryan Ray of AAII. We are talking about the latest and greatest from the world of finance and investing for the individual investor. We're broadcasting, and if you're watching this in the archive, we post our upcoming live show schedule on aaii.com/webinars, and members will have access to the full archive of shows. My guests today are Charles Roplet and John Bukowski. Today's show has three topics. First up, shadow stock updates. How did small cap stocks perform in 2020? Secondly, a look at the top and bottom performing mutual funds and ETFs. And our third segment, looking at recent trends in AAII's Sentiment Survey, which of course measures investor sentiment. Plus, our listener mailbag segment where we answer questions that are submitted. Let's get started. John, I wanted to discuss with you the 2020 trends seen in small cap stocks through the lens of our model shadow stock portfolio, which of course examines these stocks. If you could, explain to our viewers what we mean when we say small cap stocks in this context.
Sure. Well, it's interesting. The shadow stock portfolio really goes back to the research done by a lot of academics that took a look at, are there any parts of the marketplace that perhaps act differently than the overall market? We so get accustomed to hearing about the S&P 500, but that represents only a small portion of the stock market. So what academics have done is they'll take the group of companies, and they'll often use market capitalization, which is simply share price times number of shares outstanding, as a measure of company size. And they'll say rank the stocks that are on the New York Stock Exchange from largest to smallest, and they'll look at the smallest portion. In this case, the shadow stock companies look at the smallest 10% of the stocks by market cap on the NYSE Stock Exchange. We then take a look at that market capitalization and apply it against companies that are traded across all the different exchanges. So when we talk about the shadow stock portfolio, we're really talking about the smallest of the small publicly traded companies that are exchange listed. So when we first consider a stock for acquisition in a shadow stock portfolio, currently our upper limit is $300 million in market capitalization. And, so what we're really talking about, probably even nowadays, if you were to look at mutual funds, that's probably smaller than what most mutual funds who are categorized as small caps are. The shadow stock funds really focuses on the micro cap fund, micro cap part of the marketplace. These are small companies that are, they're there either because they're in trouble perhaps financially, or they're just getting started. And what they found is that potentially by investing in these companies, especially a bigger portfolio, is that you perhaps are finding companies that are poised to jump back up and become larger companies.
2020 was a tumultuous year for all of us, to say the least. How did these kinds of stocks perform generally?
Well, it's funny. There's the story of the man who drowned in a lake with an average depth of 2 feet, right? I mean, it's the return for the year. The shadow stocks had a rate of return of 13.8% last year, which, I mean, on the surface, that sounds like a good year, right? Nothing too crazy. It's not too far off from its long-term average, which is around 14.5. But in that one particular number, there's a lot of variability that's really, sort of hidden. In the first quarter alone, the shadow stock portfolio lost 48.5% of its value, and then over the next 9 months that followed, it basically gained 120.7%. So you could say that for the year it was a good year, but it was a year that you really have to kind of go into thinking that I want to be confident in this strategy, and I don't want to be forced to sell at a bad point in time, because clearly, if you sold at the wrong point of time, you could have lost half your portfolio's value. If you held on, you did well. And then what we found with small caps in general, and this has been found by academic research over the years, is that they possess what's called serial correlation. Normally, what a stock market gains or what an index gains one year doesn't have a lot of predictive value onto the next year. So if a stock had a good year, stock index had a good year in 1 year, it may or may not have that same performance the year after. But what they found with small caps is actually there is some predictive value. They tend to go in streaks. They have winning streaks. They have winning streaks, they have losing streaks. And in some ways, with the shadow stock portfolio and with small caps in general and small cap value, they're coming off of a 4-year or so downtrend of underperforming on a relative basis large caps, and they've really, since the bottom of we went from having the longest bull market to the shortest bear market. Since that short bear market, we've really been doing well as far as small caps are concerned.
You just touched on it in this answer, but I think it's a point worth repeating and asking you about. One of the central tenets of the shadow stock portfolio is that you quote, you also have to be able to accept greater short-term volatility from small cap stocks with the understanding that your long-term wealth accumulation should benefit from your patience, end quote. Do you think this advice held true in a volatile environment like the one we just experienced?
It did hold true. I mean, the key issue here is that, if you're going to get a greater rate of return, and small caps, micro cap stocks have shown historically that you can get a better rate of return by holding those kinds of stocks than you do just by holding the S&P 500, for example, large cap stocks. I mean, that doesn't come without any sort of cost. I mean, the market has some level of efficiency. So either you're going to get a better return than average because the market is ignoring you or has a mistake or behavioral bias of some sort. Perhaps they're neglecting these smaller companies, but also perhaps they're riskier. So, and the risk is a short-term volatility. So, in any given year, in fact, in the upcoming journal, we have an article on the shadow stock portfolio, and we take a look at the chance, or it's been around for 28 years now. What is the likelihood of suffering a loss in 1 year? And if you look at rolling 1-year periods over the history of the shadow stock portfolio, at 25% of the time you would have had a loss. And as your holding period starts to extend, when you're out 3 years, all of a sudden your likelihood of having a loss over any 3-year, 36-month holding period drops to 17%. And you go out to 5 years, all of a sudden the chance of having a loss over that time frame period drops to 5%. And in the context of the shadow stock portfolio, if you look at a 10-year holding period, that likelihood of having a loss over any rolling 10-year period is 0%. Now, again, that's the past. It may not return, may not happen again in the future. But the lesson there is that, with the stock market, if you're going to need the money anytime in the near term, within the next 5 years, 7 years, 8 years, you can't be guaranteed that when you go to pull that money out, it'll be worth more. But if you want to try to earn a higher rate of return that is possible, you do need that holding period, and it's called time diversification.
Gotcha. You said it earlier. I would be remiss not to mention the shadow stock portfolio's performance during the pandemic. I guess just to reiterate it, what was it, and were there any perhaps resulting changes to the portfolio strategy or rules because of the performance? The rules are always sort of adjusted, and we talked about the performance. It was down, 48% in the first quarter of the year. And what we did actually, I believe it was in the April journal at the time. I'm sorry, the May journal, the May 2020 journal. We published a chart, and it showed the relative valuation of small caps to large caps, and it showed that relationship historically. So last year we saw this big drop. We've been seeing, the relative outperformance of large cap stocks to small caps, and all of a sudden, on a relative basis, small caps were getting cheaper and cheaper. And what we noticed last year, right near the bottom of the marketplace, is that in the case of the price to book value for the stocks that are in the S&P 500, they were coming in with a price to book of 2.71. While the S&P small cap stocks, they had a price to book of 1.28. So at the time, the S&P was more than 2.1 times more expensive than the stocks that are in the smaller cap universe. Now, since we've had this big run up, we actually cover this in our February shadow stock email that goes out. And members, it's a free email. I would recommend you sign up for it. And if you go to our website, you can go ahead and do that. We actually have an article every month. We publish a little update on the shadow stock portfolio. We actually have a chart. We updated that chart, and what we found is at the beginning of this month, small caps have gotten more expensive
but large caps have gotten even more expensive. So, right now we're talking about the median for the S&P 500 going from 2.71 up to 3.93, quite a, kind of almost close to record highs as far as the history of the shadow stock portfolio. Small caps have gotten also more expensive. Their price to book went from 1.28 to 2.19. But, while that gap has tightened between the relative expense of large caps to small caps are still, below average as far as how cheap they are relative to large cap stocks. So I'm not sure if I answered your question directly, but, the rules, we're always looking at the rules and we're adapting them. We're looking for always the stocks that are the cheapest as measured by price to book, the lowest 10%, and also looking at the smallest as far as market cap size. And we do look at those numbers over time. We did adjust the price to book up a little bit last year from 0.9 to 1.0 as the cutoff. The market cap, we kept the same. We may actually raise the market cap going forward as we take a look at our normal quarterly review. And, one of the unique things about the shadow stock portfolio is that it was created with the notion of sort of being, let's take a look at what kind of research supports different kinds of rules for buying and selling stocks. But these rules, and especially in the case of microcaps, they don't make sense to trade this portfolio. There's a big cost, and it's not brokerage cost. There's a big cost of spread between buying and selling the stocks in this portfolio. So the portfolio is set up to basically be reviewed once a quarter, and we look for stocks that have gotten to be way too expensive or way too large or have earnings trouble. So it's a very simple process of reviewing, and so we're actually due for our next portfolio review at the end of this month, beginning of next month.
Thanks, John. I know a lot of members ask about our shadow stock portfolio and always curious about updates on that. So if you're curious about it as well, you can review the model shadow stock portfolio, its holdings, strategy, performance, and sign up for the email at aaii.com/modelportfolios. Charles, I wanted to bring you on to talk about the top and bottom performing mutual funds and ETFs. What were the common characteristics of those at the top and bottom? And if you could speak a little bit to which ones were the top and bottom performers.
Yeah, so when we look at the top and bottom performers, one of the things to realize is that the performance of any mutual fund or ETF is going to be strongly dictated by the type of assets it invests in. If it's a more specialized fund, the sector or perhaps industry group that it invests in. So, for instance, if we look at the bottom performers for last year, a lot of them were energy related. Oil prices were down through most of 2020. We also saw a lot of real estate funds really suffering because, again, a lot of offices shut down, a lot of people were working from home, and there's ongoing questions about whether or not people will continue to work remotely. So let's take the flip side. What actually worked well? Well, it's difference between the mutual funds and ETFs because of what a lot of mutual funds and ETFs invest in. For ETFs, we saw a lot of e-gaming sports ETFs, a lot of ETFs that focus on emerging energy technologies, batteries, solar, that type of stuff. And interesting too, the best performing ETFs are actually trusts that invest in either Bitcoin or other cryptocurrencies. So huge jump in Bitcoin last year. When we get to mutual fund side, it's a little bit more spread out. A lot of Chinese and Asian funds, so funds that, not necessarily funds that are actually operated in China, but funds that actually invest in Chinese securities, funds that target Asian countries. I want to be clear about that. We also saw, again, a lot of technology and internet mutual funds, particularly those focusing on emerging technology. So a lot of that. We also saw a lot of growth because growth was outperforming value last year. So we saw some growth funds. One thing I will say, when you look at the funds, though, a lot of them tend to be smaller in size. So for instance, when we look at the top mutual funds, many had assets of less than $10 billion. When we look at ETFs, about 40% approximately of the top 50 ETFs had assets of less than $500 million. Now for ETFs, it's important to realize that if an ETF has under $100 million, it's not a hard line, but that's usually the benchmark for where people look at it and says, and say, well, that ETF is likely to be closed. So under 500 million, it tends to suggest they haven't gotten a lot of investors attracted to the fund. So that's a little bit of a warning point. But what I will say though is when you look at these smaller funds, if you're investing in a niche industry, a small sector, or you just haven't attracted a large amount of investor dollars, it's a lot easier for you to actually have bigger moves versus if you're a large fund, you might be more beholden to investing in an entire index, so the S&P 500 or perhaps a Barclays bond index, simply because you have so much money to invest. It actually restricts your ability. Conversely, that's an advantage we individual investors have, because our portfolios are smaller overall compared to institutional investors, we have more ability to go where we want to go.
AAII has a number of first cut fund and ETF screens, some of which are labeled as hottest and top funds in certain categories. Could you walk us through the notion of funds that are first cuts, hot, and top? Are they the same thing?
Yeah, we pretty much use it. We're typically looking at performance. What fund is performing well given a certain theme. So those are very specific, and people can find those on our screening section. For those who actually want to see a broader list, show me the best performing mutual funds, show me the best performing ETFs, or I want to see what's not working. They can then go to our investing ideas side, where we actually have a top and bottom funds and a top and bottom ETFs. And on those, they can actually sort by 1, 3, 5-year periods and 10-year periods. So our first cuts are very specialized. They are screens, and they're actually designed to find funds or ETFs that are meeting specific criteria, versus investing ideas is really for casting a wider net. So it's a question, do you want to get very specific and look for certain things, and we can go to a screening section of AI.com, or you want to say you want to see a broader list, you can go to the investing ideas section of AAII.com.
Most investors naturally are inclined to look at the top performing funds and ETFs, but why might it be worthwhile to look at the bottom? Can investors look at, let's call them the proverbial losers, and apply some lessons to their portfolios?
Yeah, absolutely. I think it's important to realize what we tend to see over time is what's known as mean reversion, meaning the ones that have done really well tend to start not doing so well. The ones that did horribly tend to start doing better. Now, that doesn't mean a bad performing fund suddenly going to become a good performing fund. And it certainly doesn't mean an outperforming fund's going to become a terrible fund. But what we know when we look at broad categories, it tends to depend again on what asset, what sector, what industry, what theme is in fashion. So we don't tend to see a lot of persistence in terms of outperformance or underperformance. What we do see, however, is that funds that tend to outperform their peers over a period of time, and more generally tend to outperform their peers more years than not, tend to continue to do so, so long as their strategy doesn't change and so long as their manager doesn't change. So that's the one thing you want to look at. How is a fund comparing to its peers? So when I say peers, I mean, if you're looking at a small cap value fund, you want to compare it against other small cap value funds. A small cap value fund is not going to have the same performance, say, as a large cap growth fund, or maybe an emerging markets fund, or a bond fund, because it's so tied to the performance of how small cap value stocks perform. So you want to look at that, but it's really important to realize that if you're saying, hey, these are the top performing funds, I want to invest in these, although we do see some persistence hold sometimes for several years, sooner or later they're going to drop, and we will see periods where, again, your top performers will do really well, and all of a sudden those performers will do really bad. And depending on the industry or depending on the sector, if it's a very volatile industry or sector, say something like commodities, you could see periods where it goes one way or the other. That's why people always say be careful not to chase performance, because it may actually be fleeting.
I wanted to address some questions that came in from members about funds and ETFs. This one was submitted during our last broadcast. What is the difference between an ETF and a closed-end fund?
That's a great question. So an ETF is what's known as an open-ended fund. And a mutual fund is also an open-ended fund. So an open-ended fund can have money come into it, it can have outflows from it. A closed-end fund, by its very definition, is closed. So a closed-end fund, once it gets started, it generally does not change its assets. Now, occasionally, closed-end funds will basically do secondary offerings, where they'll open themselves up for a brief period of time, accept new investor dollars, and then they'll close off again. So what's unique about closed-end funds is they you have to compare how the fund's trading relative to the value of its net assets, because you can't have premiums or discounts. Now, with ETFs, not to confuse everybody, but you can have the ETF trading at a slight premium or discount to its net asset value. It tends to happen more often when ETFs fall in an esoteric strategy or is investing in a very hard to invest sector or type of assets. But the ETF will constantly have money flowing in and out of it because it is an open-ended fund, whereas a closed-end fund, again, once investor dollars are initially placed in it, it's closed off. Investors can't put money in or out of the fund. Now, a closed-end fund, it trades on an exchange. So I can have a closed-end fund, say I don't want it, sell it to you, Ryan, and you in turn can sell it to some other investor, versus with an ETF or a mutual fund, eventually the money goes into the fund and out of the fund, either directly between the investor and the mutual fund, or with ETFs, there's someone in the middle, a middleman, where you might sell your funds to somebody else, but eventually that market maker in the middle is going to will actually interact with the ETF to have those flows go in and out. So again, long answer, ETFs and mutual funds are open. Closed-end funds, by definition, are closed.
All right, speaking of options, this is a nice transition to the next question. This one comes in from Jay Shaw. Are ETFs viable to sell covered calls to generate some income and also get diversification at the same time?
You can do, on certain ETFs, you can actually sell covered calls. And, ETFs or broad index ETF will give you diversification. Now, what I'll say about covered calls is that you're basically betting against upside volatility. So for those who are not familiar with a covered call, what a covered call basically is, say you own 100 shares, either of a stock or an ETF. You're selling a contract to somebody else that gives them the right to buy that stock or buy that ETF at a preset price. So say the ETF or the stock's trading at $50. Maybe you sell the contract that gives another person the right to buy that ETF or that stock at $55. Now, when you're selling the call, what you're hoping is that ETF does not get to $55. It does not get to $55, or more specifically, does not get above $55. Because say that ETF goes from $50 to say $57 before the contract expires. If I hold a call contract, I'll go back to the seller and say, sell me those shares, because I know immediately I can make $2 per share in my position. So you're the person who sold the contract. All of a sudden you have shares that are worth $57, but you're forced to sell them for $55. So you're basically, again, hoping it doesn't appreciate over a certain level. You're also having to constantly resell your contract. So you could be forced to sell a stock or ETF before you want to, and you might be selling at a price that's below what you want. So you're taking a gamble that you'll be able to collect enough in covered call premiums so that when you finally do get called on a covered call, or worse yet, if the ETF or mutual fund takes a huge plunge, then you have to cover your call and then sell the fund. So you're really hoping there isn't a lot of volatility, because you can get hit on the downside. If it falls enough, then you have to close out your option contract before you can sell the ETF or the stock. Or if it rises, you'll lose out on potential profit. So you're really hoping those two things don't happen, and that you'll get enough profit from the covered call before you do. So the one thing about options is they look really simple. They sound really attractive when someone's explaining them to you, but in reality, it's not so easy to necessarily make money off of options.
And this final one comes in from Melinda Harper. She asks, when is an ETF too big?
It depends on the ETF. That's a good question. If you're looking at an ETF that invests in the S&P 500, the Russell 1000, some other large, well-capitalized index, it's not a problem. But if you're looking at ETFs that are trying to invest in niche industries, then it becomes a problem. And it's not just with ETFs, it's also with mutual funds. And what happens is basically they have too many dollars to invest for too few assets, which means they have to spread out their strategies. With ETFs, they tend to follow indexes. So what might happen is the index provider themselves might adjust the index to catch a broader net. Now, what that means, the ETF, it might have done really well with a very specialized strategy, but all of a sudden it starts to have it going further and further out. We saw this several years ago with during the late 90s with mutual funds are investing in Russia. They were doing really well, but because they're doing really well, they attracted a lot of dollars, and it got to the point where these mutual funds had too much money to invest in Russia, which at that time was still a developing country in terms of its capitalism. And these ETFs really got too crowded. So in general, when you're looking at investing strategies, you don't want to have too much money going into a fund or following a specific strategy, because there can be instances where you have too much money. But again, if it's a broad index, say like the S&P 500, the Russell 2000, it's not as big of a problem.
Thanks, Charles, for explaining all that about funds and ETFs. I learned a lot there. Folks can take a look at the February 2021 issue of the AAII Journal at AAII.com/journal, which of course features our annual mutual fund and ETF guide. That does include tables and associated spreadsheets. As mentioned, we've also got fund and ETF first cut lists available under the screening tab of our website, as well as the investing ideas tab. I should have shown it on the screen there. Thank you.
Thank you, Ryan.
Charles, if I was to look for a personal feeling on the past year, I'd say I was feeling rather bearish generally. But the process of surveying investor sentiment is something that we've been doing for a long time at the association. What is your sense of how individual investors have felt about the markets lately?
Well, it's interesting. So last year, when we looked at our sentiment survey, and just to back up, so our sentiment survey asked AAII members how they feel the market's going to perform over the next 6 months. And it's bullish, meaning the market's going to rise. It's neutral. I think the market's going to be about flat. Or bearish, I think the stocks are going to fall. That's the same question. We've asked it consistently since 1987. And what we found last year was most of the year, people were not very optimistic. We actually had the lowest average level of bullish sentiment. It was actually the 4th lowest in the history of the survey. Only 1990, 2008, and 2009 had lower average bullish sentiment. So if we look at the bullish sentiments, which comes out every Thursday, the sentiment readings, if we look at the average over the last 52 weeks during 2020, it was the 4th lowest in the survey's history. But there's a caveat. As soon as we started getting positive phase 3 trial news about the vaccines from Pfizer and then Moderna, we saw optimism actually rebound. So people are concerned about the pandemic, news about the vaccines came out, we saw the market continue its climb, and we saw investor optimism rise. So where are we at right now? So our survey period actually runs from Thursday at 12:01 a.m. If you're up late at night and you want to take it first thing Thursday, you can go ahead and do it, through 11:59 on Wednesdays, and those are central times. So most recently, for the last survey period, we saw bullish sentiment at 45.5%. So to put that in perspective, that's within the typical historical range. So if we look at the whole history of the survey, going back to about July 1987, and we look at all the bullish sentiment readings, we can see this is actually within norm. And so it's really important, because when people look at the sentiment survey, they tend to look at the number and they might say, oh, that's 45%, that seems high. You really want to consider the range, because that really tells you, is this a normal reading, or is this unusually high, or is this unusually low? So right now, more investors are bullish than bearish. The split is 45% bullish, about 26% bearish, and again, both are within their typical ranges.
All right. Okay, here we go. Broadly, what drives investor sentiment is current events and politics that impact the global economy. Of course, it's hard to predict what will happen next or how investors will feel about it. How do you think these events translate into entire movements and periods of a bull or bear market?
Well, I think it plays a big role, and part of the reason is what's known as recency bias. So we humans tend to really focus on what's happened now, and the reason why it's simple, it tends to be very front of our mind. So we can identify what's going on. Maybe it's, what's happening in Washington, D.C. Maybe as we talk, maybe it's what you see happening with the coronavirus. Maybe it's your views of the economy. We see this in Gallup polls. Whenever they survey people about what they think about the economy, there's always a partisan split between Republicans and Democrats. When a Republican's in the White House, Republicans feel really optimistic about the economy. When it's a Democrat in the White House, you see Democrats feeling really optimistic and Republicans feeling less optimistic. So people do have their own biases impacting their views of the market. And we also tend to see the market movement playing a role as well. So, but what I will say is, although we see our members' sentiment being reactive to what's going on and what they're hearing and what the headlines are, it doesn't necessarily influence their asset allocation. In fact, our members tend to be less reactive with their asset allocation. So people tend to think, oh, this person's feeling bad about the market, they're going to react. Very often, investors might say, you know, I'm worried about the market, or, you know, I'm absolutely excited, I think this is going to happen. But they don't necessarily let that influence their allocation decisions, which is great, because it's okay to be scared. It's okay to be excited about the markets, but you shouldn't make your investment decisions based on that. And over the long term, we tend to see allocation change a lot less frequently than we do our sentiments.
I think you just went over it, but I'll ask you the question anyway. You know, of course, bearish, bullish, and neutral are different points on the sentiment scale, and some read into these sentiments to make market moves. Is that advisable for an investor to adjust their portfolios per recent sentiment? I guess I'm wondering how the average person should view these sentiment readings.
No, that's a great question. So people actually go to the AAII.com/sentiment survey, or you can access it through the latest tab. They can see the most current sentiment survey readings. They can also see the historical readings as well to kind of get a gauge of what's going on. There's an old adage in markets that says buy when there's blood on the streets. Basically, the inference is that you should buy when pessimism is high. I've done historical analysis on the sentiment survey, and what I found from our readings, they actually suggest buy when nobody's optimistic, when everyone's not very giddy, not really excited about buying stocks. They really think the market's going to fall lower, or at least they're not really thinking there's going to be sunlight at the end of the tunnel. That's the time you want to buy. It's when optimism is actually low. And that's the time when you might want to be a little bit more cautious when optimism is high. So let me give you some readings. So we actually use what's in a standard deviation. So we draw this typical range, what the bullish sentiment is, and then we look for the outliers. What tends to be unusually low? What tends to be unusually high? So at the low side, bullish sentiment readings below 27.9% tend to be unusual. These are readings that we don't see very often. When those occur, we tend to see the S&P 500 up about 8% over the next 6 months, and that's an above average reading for the S&P 500, above average gain. So when you see optimism being really low, historically there is a link between that and market outperformance over the next 6 and 12 months. When optimism is really high, meaning it's above 48%, the average return for the S&P 500 is about 3.7%, and this compares to about 5.5% for all weeks since 1987. So when optimism is really low, you see S&P 500 tends to get much higher returns. When optimism is really high, it tends to get below average returns. Now, I do want to point out, though, it's a link. It's not causal. Stocks don't rise just because nobody's optimistic. Stocks don't fall because everybody's optimistic. It's a sign. Take a look around. What else is going on? What's happening in the news? What are valuation? What are the economic trends? What are the earnings trends? So I don't want to encourage people to look at the sentiment survey and say, aha, it's doing this. I'm going to make this move. It's more of a sign, aha, I see this. Well, let me go take a look at the broader mosaic. What else is going on? What should I be paying attention to? So it gives you a sense of what investors are doing. We do see this link, but it's just one piece of a broader puzzle. And I don't think there's any single indicator that necessarily should guide somebody's decision to either be in stocks or be out of stocks or to tweak their allocation. They really want to consider what their goals are, what their risk tolerances are. And again, if they're following a more tactical strategy, consider several factors, not just one.
Thanks for breaking that down, Charles. The AAII Sentiment Survey is run weekly, and as you mentioned, you can read and contribute your own input into the weekly readings at AAII.com/sentiment survey.
Thanks, Ryan.
And now for our listener mailbag segment, where we address questions that have been submitted by viewers and AAII members and answer them here. If you have a question for us, you can submit them using the questions panel in your GoToWebinar control panel, or you can email me. My email is rreeh@aaii.com with the subject line II show question. All right, Charles, these questions came in and I wanted to have you answer them. This one comes in from Mike Esk. Mike S., he asks, do ETFs charge 12b1 fees? What fees are associated with ETFs?
So ETFs do not. So 12b1 fee is charged by some mutual funds, not all, but some, and some marketing expense. It allows them to market the fund. ETFs do not do it. They do charge operating expense ratios. So you'll basically see it's expense ratio you see quoted for the ETF. That's all its costs to get charged for you. And so it's basically an annual expense ratio. It gets taken out of the fund assets and thereby your return. So the 12b1 fee tends to be a charge when you buy the fund. It's a small fund. You often maybe like a quarter of a percentage point, but it's only for mutual funds to be able to market. And a lot of mutual funds don't charge it anymore, versus ETFs do not have that fee.
All right, this question came in from Boban J. He asks, is there a way to know how the price of an ETF compares with the price of the underlying equities?
Absolutely. So you can often go to the ETF's website and see exactly whether it's trading at a discount or a premium to its net assets. They'll actually put it on that site to see it. But the general rule, again, is it really depends on what the ETF is investing in. If you're looking at a broad ETF or broad market ETF, it's generally going to track that index really closely. It's more so when it starts getting to more specialized assets and more specifically specialized strategies. Now, what you can do is on our ETF guide, we go through, actually download the spreadsheet. We do have market returns and net asset returns. So you can see over time which ETFs tend to follow their net asset value pretty closely and which tend to have some variance in their annual returns.
All right, thanks for answering those questions, and thanks to our viewers for submitting them. Again, if you have a question for us, you can follow along with the instructions below. You can submit them using the questions panel in your GoToWebinar control panel, or email me, rreeh@aaii.com with the subject line II Show question. We will get them on air for the next Individual Investor Show. Thanks, Charles.
Thank you, Ryan.
If you liked our show, please visit aaii.com/webinars to register for more great webinar and video content. I invite you to like us on Facebook and follow us on Twitter at AAII_invest_ED. For more investing education, check out our website, AAII.com. Again, I want to thank our guests, Charles Roplet and John Bukowski, and you for listening. We'll see you next time.